understand how a balance sheet is constituted, how a P&L is constituted, and how cash flow is prepared from these two, and probably what kind of ratios or what kind of basic analysis we can do on the financial statements. Now let's focus on some of the key elements of these financial statements. One is the inventories. We have covered some portion of the inventories in bits and pieces as a part of the income statement, something in the balance sheet. We have covered a bits and pieces of them, but we'll take that entire thing collatedly at this place. Similarly, we'll also look at a couple of sessions focused towards the long-term assets, non-current assets. We'll also look at something on non-current liabilities. So, covering each and every element of the balance sheet and income statements in depth. Some portions of them we'll be looking at as far as this course is concerned. So, we will look at the inventories to start with. Some of the things we may be knowing as a part of the inventory already. Yeah, what all costs we will treat as inventories, because see, when we discussed earlier, we said whatever we are purchasing for a production purpose, let's say a raw material, right, or a semi finished good, let's say we got that. Now once we have got it, what all costs corresponding to that should I treat as inventory? And one part we have to remember is the inventory, the total cost which you are spending on the raw material, it is actually getting broken down into either cost of goods sold or inventory. Correct? Depending on if that item got sold in this period, if that raw material has gone into the production and that item got sold, that cost is being treated as a part of cost of goods sold, and the remaining, if at all that item did not get sold, it is going into the inventory. Now what is that cost? Is it just the purchase cost of that raw material? What cost should I include as a part of the cost here? That is where the mechanism says, apart from the purchase cost, whatever the raw material purchase cost that was there, apart from that, you include the conversion cost also. Conversion is, let's say you have see, even a finished good also, until it is sold, we call it as inventory, right? I have got the engine, I have purchased the engine, but so that engine was purchased at some price, right? Some cost I have incurred on the engine, but after the engine came, which was a raw material, I have transformed it into a bike. I have used that as a part of the bike, and there is some extra cost that was involved in that also. That is what we are calling as processing or conversion kind of a cost. But the bike is still in the store only, which is still an inventory, right? So whatever the cost that was additionally incurred in terms of, it could be labor, it could be a machine, it could be electricity, whatever it is, whatever is the cost that extra incurred for transforming the raw material into a finished good, even that has to be included. And the transit related, whatever are the costs that are incurred to bring the inventory to the current location and condition, which could be transportation, right? So all that, whatever you are incurring, freight charges, all those which you are incurring, that entire thing is treated as a cost. That cost, no other cost will be there. Let's say repairs, maintenance, right? Most of the storages, they don't get treated as a part of the cost. Only the purchase price and whatever is the processing or conversion kind of a cost from a raw material stage to a finished good kind of a stage. And finally, the cost that is incurred to bring it to the current location and condition. It may involve 4 or 5 times transportations also, or assembly line. I may have to move up to certain stage. It is processed in this plant, but the stage 2 happens in some other plant, right? Some other location. Whatever are the transportation costs that are incurred for this entire thing, even that would be treated as your cost. And that cost is what is split between the cost of goods sold and inventory, not the purchase price, right? And then some of the other costs which can come up in that same process, which is like there will be some wastage. Regular wastage is still considered there itself, assuming 1% wastage, 2% wastage. You can take it out directly as a part of inventory itself if it is a regular. But abnormal kind of a wastage that is coming up, which you may not expect at the outset, a big wastage, spoiling, perishing, something coming up, which is not a regular one, then you have to treat it as a periodic cost. And that periodic cost does not go into the inventory, it goes as an expense in the income statement itself. That will not be treated as a part of the inventory cost. See, if you can predict something, yes, 1% of my, if you can reasonably out of your experience say that, yeah, 1% of my material generally gets perished. Then when you are treating the cost, you treat the cost of 99% itself. Whereas, if it is something more abnormal, then you will not consider it as a part of the inventory. You will consider that excess as a loss in the income statement for that year itself. You have to treat it separately as a periodic cost because it is not a regular kind of stuff. It happens only once in a while. Then similarly, most of the storage costs, unless if you store something that you have spent on some kind of a storage which has a very long term kind of a benefit, unless that is the scenario, most of the storage costs are treated as expenses, and that cost you don't add it to the inventory cost at all. It is treated as a separate administrative expense. Similarly, any other administrative expenses that are there apart from storage, like writing or documentations and various things that are associated, all those we will not treat them as a part of inventory costs. Only those 3 items, better remember in that way, only the cost of purchasing it, transforming it and bringing it to the current location are treated as a part of inventory costs. Rest all they will be treated as periodic, which will keep occurring every period, every quarter, every month. They keep occurring. When as and when they occur, you will treat it as an expense. See, in a normal scenario, what happens is, let's say you require 100 raw materials. General tendency in a company is, if they assume that there is around 10% wastage every year, what they do is, when they are purchasing itself, they purchase 110, assuming 10% of it will generally go waste. So that part anyhow regularly gets treated as a part of the regular mechanism itself. Whereas when it comes to the abnormal part, though I have purchased 110, only 90 are good. Another 10 I have lost. That is where the abnormal wastage is coming into picture. So some of these things we have looked at earlier from an analyst standpoint. When I am considering a LIFO, last in first out. Now just we have taken one example also earlier. Let's say I am talking about Jan and April and July. I am purchasing some raw materials, buying, let's say I have sold the finished good in September.